In this section, we are going to cover 5 different benefits that factoring currency correlation into your trading can have. The first is that it can help you to eliminate counterproductive trading. You can use currency correlations to help you stay out of trades that just cancel each other out. So since Euro USD and USD CHF move in opposite directions almost 100% of the time, you wouldn't go long on the Euro USD and short on USD CHF. This would just be pointless, and actually you would pay for the spread twice. The second way this can help you is to leverage profits or losses. You have the opportunity to double up on positions to maximize profits. For example, if you have 2 pairs that have a strong positive correlation like GBP USD and Euro USD, and if you go long on both pairs, you could potentially win double the profits. But of course, you could also lose double the amount. So just be careful with this. If GBP USD is following behind Euro USD, it could help you to predict where GBP USD is going next as well. The third way currency correlation can help you trade more successfully is by helping you to diversify your risk. So rather than trading a single currency pair all the time, you can spread your risk across 2 pairs that move the same way. You can pick pairs that have a strong to very strong correlation, so around 0.7, like the Euro USD and GBP USD. Because it's not a perfect +1 correlation between the 2 pairs, it gives you the opportunity to diversify your risk. For example, let's say you analyzed the Euro USD pair and decided to go short. Instead of opening one big short position on the Euro USD, you could open one on the Euro USD and one on GBP USD. In the event that the US dollar sells off, the euro might be affected less than the pound. This can help you diversify your risk between more than one pair. The fourth way you can use currency correlation is to hedge your risk. What exactly is hedging? Hedging is where you offset the potential loss of one trade by taking another trade in the opposite direction. So if you were in a long position on Euro USD, at any point if you also open a short position on Euro USD while the other trade is still open, you are hedging to minimize the loss of the long position. So taking that same example, if you open a long position on the Euro USD and that position started going against you, you could open a long position on a pair that moves in the opposite direction of the Euro USD, such as the USD CHF. This can help you to avoid major losses. And the cool thing is that while the Euro USD and USD CHF are almost perfectly negatively correlated at -1, their pip values are different. And what do I mean by that? And why should you care? Let's say that you buy a 0.1 lot size position of USD CHF and 1 pip of USD CHF at this lot size equals 93 cents. If it started to move against you, you could hedge by buying a 0.1 lot size position of the Euro USD. 1 pip movement of the Euro USD at a 0.1 lot size equals $1 at this time. So now as the USD CHF falls 10 pips, for example, and you lose $9.30, the Euro USD would win 10 pips, which would be $10. That would completely hedge you out, and you would actually net 70 cents, which would probably cover the spread and commissions. Of course, there are some disadvantages to hedging, like if your Euro USD position took off in the direction you were hoping, but you were hedging with the USD CHF position, you would miss out on a lot of profit because all of the losses from the USD CHF position would cancel out all of your profit. Also, you have to be aware that the correlation between 2 pairs can weaken at any time. So if the Euro USD goes up 5 pips, the USD CHF might fall 10 pips. It's not always going to be a perfect science, so just be careful when you're hedging. The final way currency correlation can make you a more successful trader is by helping you to confirm breakouts and avoid fakeouts. Let's go through an example of how you can confirm your trade entry or exit signals using correlated pairs. You're looking at the Euro USD and you see it testing a support level. And let's say that you believe it's going to break through the support level to the downside. You know that Euro USD is positively correlated with GBP USD and negatively correlated with USD CHF and USD JPY. So you check all those pairs to see if they're all making the same magnitude of moves as Euro USD. You notice that the positively correlated pair GBP USD is also trading right by a support level, and the negatively correlated pairs USD CHF and USD JPY are trading right by resistance levels. This confirms a possible breakout because the other 3 pairs are moving similarly. So With this confirmation, you could decide to trade the breakout once it occurs, since it most likely won't be a fake out. If you looked at the other three pairs and the positively correlated GBP USD wasn't falling like the Euro USD, and maybe the USD JPY isn't rising and the USD CHF is just sideways, that would be a strong sign that the move to break through the support line may just be some random movement in the market. It could possibly break through and then return back to the support level, resulting in a fake out. Can you see how positively correlated pairs behaving similarly or negatively correlated pairs behaving in the opposite way can help you to confirm if the move is real or just a fake out? Pretty cool, huh? I hope you've been able to see how currency correlation can help you trade more accurately.
Hey, thanks so much for watching. Make sure you join our free Discord channel to get access to all the cheat sheets and a bunch of other cool bonuses. The next video in the course is right here.